Back with First Trades, right here on ET Now. Let's welcome on board Rajat Kathuria, the CEO at Signature Global, joining in to talk about how their quarter has been and, of course, the visibility going forward as well. Rajat, hi, morning. Good to have you on ET Now. And Q2 has been excellent for you in terms of your pre-sales, profitability, margin expansions. Tell me, what were the growth drivers for you?
Yeah, you're right. I think the entire H1 has been quite good. Usually it's said that H2 is good for real estate, but we've always been maintaining that it's more driven by the supply being created in the market. So in the first 2 quarters, every quarter we've done a one large launch, which has driven most of the sales. So we've launched one large luxury group housing project called Titanium SPR. And in Q2, we launched an integrated township by the name of Daxin. On both the projects, we saw phenomenal response, and sales are going well even as we speak. Even during the festive season, we saw, good traction around sales.
Right. And what's helped your margin expansion? And can we expect, your margins to stay comfortably at these levels?
Margins are going to be very comfortable. We've been maintaining a guidance of about 35% EBITDA levels on the sales which are currently being done. So for this year, our guidance is that if we are achieving, pre-sales of about 10,000 crores, the embedded EBITDA is about 35% on these sales. And we stay comfortable with this guidance.
Okay, fair enough. Let's move right on then and talk a little bit more about the outlook on your net debt, because that has seen an increase in the first half. What is the debt looking like at the end of on your books by the end of FY25, and how will it likely be mobilized?
So our net debt, just to correct, has come down a little. So during the first half, we created a cash surplus of about 800 plus crores, which we deployed primarily towards land acquisition. So about 500 plus crores was deployed towards, towards land acquisition for future projects. Net debt reduced by about 140 crores. So our net debt as of today stands at about just a little over 1,000 crores. By the end of this fiscal year, I think that number should be below 500 crores.
Okay, and what about your latest project, Daxin? What kind of a development is that? What kind of revenue potential, more importantly, do you see?
From the land which we acquired?
Yes, the project of Daxin, in terms of the development, what is the kind of delivery timeline that you're looking at?
Sure. So, see, Daxin is quite unique. It's almost like 125 acres integrated township at the periphery of Gurgaon, which we call as south of Gurugram. It's just on the peripheral area of Gurgaon, and that has 2 or 3 main components. We've launched 2 out of those 3 components. First is mid-income housing, our bread and butter business, doing premium independent floors with I would say, in the current context, very affordable sort of ticket size of around 2 crores is, what we are selling. These are good quality homes with good amenities. So that was quite awaited in the market and has seen a very good response. In addition to that, for the first time, we've tested selling some industrial stroke ITITS, startup plots. So, even that has seen very good response. For this entire development, I think delivery time frame will be between 2 to 3 years, and it's been a super success.
Okay, that's Project Dakshin. What about the outlook in terms of the rest of your project pipeline? What's that looking like, in particular when it comes to the affordable and the mid-income portfolio? What kind of potential revenue do you see over the next 2 to 3 years?
So see, if you look at the trailing 9 months, we've crossed 9,000 crores of sales. So year to date, effectively. So we are crossing, about 1,000 crores of sales on a monthly basis. So for this year, we stay very comfortable with our guidance. And we've not yet rolled out the guidance of the coming year, but, one can safely assume a 25% YOY growth in pre-sales, on the platform.
Right. Rajat, I wanted to understand about, the regulator now and the central bank as well, sort of clamping down on NBFCs and especially, the unregulated NBFCs which are into MFIs. Could this really turn out to be a risk for your business?
So see, in the past, we used to borrow from NBFCs for land acquisition. Lately, a lot of acquisitions happening through internal accruals only. So our dependence on NBFC borrowing is extremely low. We are usually just borrowing from larger banks. In general, I would say as regards monetary policy going forward, with interest rates coming down, that can have a further positive impact on the sector. So that's what, we will wait to watch, in next few months' time. So, but besides that, we're not dependent on NBFCs, nor our customers are dependent because they're usually, borrowing from larger housing finance companies or banks.
You don't see any effect on demand for affordable or premium housing at all?
So, see, in the current situation, we are doing more of mid-income homes, mid-income to premium homes, you could say. There's very little or literally zilch affordable housing happening given the current land prices in the market. But we see good demand, and it's getting displayed on a quarterly basis. So we are keeping fingers crossed and, busy with doing regular sales.
Okay, appreciate your time then. Thanks for joining in, giving us a sense of your projects, the timelines, and more importantly, the revenue potential as well that you.
If you like this video, then like, share, and subscribe to ET Now.